asked by some would-be investors kind of what metrics they should be looking at. And if you, or really anyone, myself included, as soon as you like do a quick Google search, you're gonna find all these different metrics, how to measure your investment, and if you should, what your returns are going to be over 5 years or 10 years. And I think there's just a lot of noise there that a lot of beginner investors need to just disregard. And I actually find myself doing that. I even find that experienced investors and people with like 50 units, they, for the most part, use these beginner level metrics because it gets the job done. So I'm going to share my screen just like last week, and we're going to jump right into it. So also just want to shout out, thank you, David, for letting me know that the screen was too small to see last week. So I now have the zoom set to 200. Hopefully this helps. Quick disclaimer, brokerage has asked me to do this. I cannot give client level advice without a formal contract. It's a state of Maine rule. So this advice is going to be high level, kind of blanket advice, but you should talk to your favorite broker, hopefully it's me, about any specific advice regarding your specific situation. So that being said, I think there's a few terms that we should define first, and that is net income, which you will sometimes see as NOI. And this is going to be your gross income, so what your rents bring in minus your expenses. So this is going to include taxes. These expenses do not include your mortgage. So when it comes to real estate investing, to price a property or kind of to like go to the market, we need to find a way to kind of level the playing field in terms of every buyer's situation is different. And some people are going to buy a property cash. Some people are going to finance 95% of it. And some people are going to fall somewhere in between. So we got to find a way to talk about the property in a way that would work for all people. So when you see people talk about net income or NOI, they're talking about the gross rents minus the expenses. And this is going to be property taxes, utilities, snow removal, stuff like that. Your expenses to run the building, run the property, that is what's calculated into the NOI. We don't include your mortgage payment because, again, some people are going to have it, some people don't. Note on this, depends on the listing agent, you may see that vacancy may be removed from income. So when you're running your numbers in a spreadsheet, you don't know what your occupancy is going to be for the property. Maybe you're going to always have tenants and you have such demand for your property that when one tenant leaves, within 24 hours, someone moves in. That could happen. So you might never miss a month's rent. So what people do when they're, penciling out the properties on paper is they usually take out a percentage of vacancy, like 3% or 5%, just some number that, assuming that you're not going to have full occupancy. Now on the spreadsheet, that's how we kind of like lower the income a little bit. In practice, you really, again, general advice, you should put away money every month to cover mortgage expenses for those months that you're missing a tenant. And this is extremely important when you have a small investment property, like a 2-family, 3-family, where one tenant missing has a huge impact on if you can pay the mortgage or not. Once you get into a larger building, 6 units, 10 units, for the most part, half the units are going to cover your mortgage cost and the rest is going to cover, your expenses and reserves and your income, your cash flow from the property. So it's a little bit, you don't have to be as stringent on it. But anyways, back to defining the terms. I wanted to talk about that, and then I think that's the major term I want to talk about. So the first metric, let me scroll here. First metric is capitalization rate, or cap rate. So you hear this a lot, a term thrown around, specifically once you get into larger buildings over 4 units, so 5 or above units. And this is how we can compare apples to apples, or we try to compare apples to apples. So the cap rate is your net income divided by the total price. And so this is how we can determine, again, so we can compare 2 different 5-unit buildings. One may be a brick building, one may be townhouses, side by side. How do we compare these different layouts and these different setups based on their income? Another way to look at that is, how do we compare, 2-bedroom apartments, a building with a bunch of 2-bedroom apartments, to 4-bedroom apartments, and which one's more desirable? So again, for the cap rate, capitalization rate, that's the net income divided by the total price. So an example, like I was just looking at before this call, there was a building that expired. It was a 12-unit building. It brought in $78,000 net income. They were asking $1.6 million. So that gives a cap rate of, I think it was 4. Let me just, 78,000 divided by 60 million. 1.6 million is 4.8%. So that's how you calculate cap rate. Again, cap rate is also good. You can use it on the flip side. Can use to determine new value. Thank you, autocorrect. So if you were to take the net income at rate, for example, this building was 78,000. If you were able to raise the rents, raise the income, lower the expenses, say to 100,000, and then you use the 4.8 cap rate. Sorry, this is hard to talk and type. New value is 100K divided by 4.8%, which equals, I should be able to do that in my head, but 2.08 million. So again, we use cap rate to kind of talk about and compare list price, asking price to net income. And again, you can use it both ways on, this is, a property listed at 1.6 at a 4.8 cap rate. Okay, I know that's going to bring me in $78,000. Opposite, I know if I raise the net income a certain amount, I increase the value of the property. So the next metric that you need to focus on is, and this is kind of 2-in-1, is cash flow versus cash on cash return. And so these terms, I want to say they get used interchangeably, but they definitely mean 2 different things. And I think people aren't careful on how they talk about it. Again, like I mentioned at the beginning, or when we're talking about net income, we don't include your mortgage payment, your debt service cost. And that's because some buyers are going to be cash, some buyers are going to use a mortgage, and some are going to only need a little mortgage versus a large mortgage. So these two get kind of mixed around, and they're not the same. So cash flow is another way of talking about net income. It is your income minus expenses. So when you see someone say cash flow versus net income, they're talking about the same thing. cash on cash is your cash flow minus your debt. Sorry, I gotta put some parentheses here, back to the engineering equation world. There's the cash in the deal. So even if you bought the property 100% cash, you can still use your cash on cash return. But like I said, I just think I'm finding that people use those interchangeably, and they definitely mean two different things. So for most of the people that I work with, they're going to get a mortgage. So really cash flow doesn't matter at the time that they're purchasing right now, right? Yes, they may eventually pay off the mortgage. Like that's the goal, to have tenants pay off the mortgage over the next 15 to 30 years. That's, what we want eventually, to have a property with no debt. You own it 100%. But right now when we're buying it, it doesn't really make sense to use that as a measuring stick on if it's a good deal or not. Instead, a better tool is this cash on cash return, which is going to be your cash flow minus your debt payment, what your debt service is every year, divided by the cash in the deal. So for example, let's try to use round numbers. So if I have a net income of 100,000 and it costs me, my debt cost per year, sir, is 50,000, and I needed, these numbers are going to be hard in my head, and I need to put a down payment, cash in the deal equals 500,000. This is me definitely doing this live, not preparing this, so I apologize. So if we know that, so we have cash in the deal, or here, I'm thinking and not typing. So NOI minus debt, that's an easy one, that's 50,000. So our cash on equals 50K divided by 500K equals 10%. So that would be your cash on cash return of 10%. Now, what this cash on cash return, good to compare. This is good to compare to other asset classes like stocks. So when you're, sometimes depending on your situation, it might not make sense right now to buy real estate as an investment asset. Maybe let me scroll here so you guys can see, sorry. Maybe it makes more sense to buy stocks. And if that's the case, you need a way to compare on, would I get a better return on my investment would I be getting a better return on the cash I have if I use it to purchase a property versus investing stock? So in this case, that if you had $500,000, you could go buy a property. It would cash flow, your net income minus your debt service would be $50,000. So that'd be the, excess money you would get every year. You would get $50,000 in your pocket, kind of, divided by the $500,000 you put in. So that'd be a 10% cash on cash return. So to compare it to stocks, if you went and bought $500,000 worth of stocks, could you get a 10% annualized return on your investment? So again, this is how we kind of compare. Like, it may not make sense for your situation to buy real estate. Maybe you go buy stocks instead. And then, you don't have to think about it. Now, yes, there are other advantages of buying real estate. We're not going to go over that right now, but this is a good way to, determine on, this deal make sense in terms of, could I go get a better return on my money somewhere else? Let's see. I need to go. The third and final metric that is really important, again, because most people I work with are going to get a mortgage, is the debt service coverage. Debt service. You'll see it as the debt service coverage ratio. Why is this metric important? This metric is what lenders use to determine on if they're going to give you a mortgage on the property. So again, if you're buying it cash, you don't really care about your debt service coverage ratio because you don't have it. However, most of us do. So this is going to determine that. It's your net income divided by your debt service. So like, what is your, do you have enough income to cover paying your mortgage? That's basically what this ratio is determining. So in that example from above, so we know that our net income, the net income was 100K, and the debt service every year was 500K. So we know that, so we can then calculate our debt service ratio equals 100K divided by 500K, which equals 2. So that's how you determine your debt service ratio. What I have found, most banks, and every bank is different, and your lender might have a different requirement. Most banks require a debt service ratio of 1.25. And so this means that you have basically a little bit of wiggle room on if expenses go up drastically, if income goes down, like, is there a nice cushion? Would you be able to pay the mortgage if something happened? So and this is becoming a problem. This metric is really important because it's actually becoming a problem with clients I have in terms of, we're seeing properties come to the market where the debt service ratio is so bad, like it's so low. So that basically means that your asking price for the sale isn't support. I can't go get a mortgage to cover based on the income you're bringing in. Now, that's not saying that someone won't ever buy the property. It basically means, an investor would either need, for a seller in that situation, someone could buy their property and still may. But the difference there is that the buyer would either need to be all cash or have a mortgage that's smaller. So if in the situation I'm thinking about when I was talking with a potential seller, I think I calculated, the average investor wants to put 25 to 30% as a down payment. And that's usually right around where banks require you to do anyways. So that's kind of where they want to be. They want to put down 20 to 30%. Well, the income that these people had coming in, you would have needed to put down like 50% or 60% of the value. So like that down payment's too big for most investors, unless they're, they just recently sold another investment and they're trading up, et cetera. So it's still possible, but for the average investor, we need to find a property that the debt service ratio is greater than 1.25. So, like I said, in this example, it works out great. Now, I think a lot of people would probably jump at a deal like that. So I'll keep my eyes out. So I think that is, it's about 20 minutes in. That's about the 3 major metrics that I think you need to know as you're starting to invest in real estate. You need to know about cap rate. because this is how properties are kind of priced on the market is, what's the net income, what's the cap rate, what's the going cap rate, ratio between net income and asking price. And that's how properties are listed. And then you need to know cash flow versus cash on cash return. More specifically, the cash on cash return. Again, most of my clients are not buying, even $300,000 property, investment properties cash. Most people are putting a mortgage on it. So which is more important is the cash on cash return. Again, maybe it makes sense to go buy some Tesla stock instead of buying this real estate property. And then the next ratio is the debt service coverage ratio. Is the property financeable with the down payment you have and the income coming in? Will it work? I guess the one caveat I want to put here, I'm going to go back here. So not used for under 4 unit pricing. So I know I just went back and went over that. This is important. We want to highlight it. Went over that you can use the cap rate. The cap rate shows the ratio between net income and total price. The problem here with that is that, I'm trying to switch screens here. The problem with that is it's not how we price investment properties that are considered that you can get a residential loan for. Now, this is the point of this video, was not to talk about the different pricing strategies and how properties are priced, based on the size. Maybe that will be next week's video. But when you're under 4 units is a gray area. You can go back and forth, but usually under 4 unit properties, so a single family, 2 family, 3 family, 4 family, you can get a residential loan. And the idea there is that you could, in theory, live in the property in 1 unit and rent out the remainder. So you could go get an FHA 3.5% down loan. You could get a conventional 20% down loan. Regardless, you can use a residential loan product to purchase. So as such, the values are determined based on residential practices, which is based on comparable sales. So they don't use cap rate. Cap rate is sometimes used as a back check, but the value of a property or the asking price of a 3-unit property in Portland is not going to be based solely on what is the net income it brings in, but rather what are the comparable sales in the area for other 3 units. And so this is why some of my investor clients have basically said, I'm done with residential. I only want to work with commercial properties, which is going to be, again, the 4 is that gray area, but typically 5 units or above, because commercial lenders look at it as a business. What does this building bring in for income? And that's going to determine what we're going to offer you for a mortgage or a value for the property, which you can get a mortgage on. So that's where the cap rate is critical, because it's like, the market is saying that people are willing to pay a 6% cap rate. So if your building brings in X amount of income and the market says people are willing to pay right now 6% based on income, now you got a value. So I just want to add that clarification there, that cap rate, while any investor at any size can use it as a means of, should I buy this or not, based on the income, when you go to get a loan, lenders are going to look at them differently if it's a residential or a commercial product. So that's all I got for the 3 metrics that you need to focus on: cap rate, cash on cash return, and debt service ratio. So I do want to, like I said in the disclaimer, it may not make sense. I can't share all the details on your specific situation. So I just put in the chat my calendar link to book an introduction call or discovery call, whatever you want to call it, where we could sit down, maybe talk a little bit more detail about your situation. Again, maybe you have enough of a cash down payment where you might not need a mortgage, or you're very limited and you want to buy a property where you can live in part of it. Everyone's situation is different, and we got to look at the metrics a little bit differently based on your end goal. So again, I put that link down below or in the chat. Hopefully it pops up. If you want to have a, no contract required call just to talk a little bit further and answer any questions you have, please don't hesitate to reach out there, and I'd be happy to chat. We can do it over video call like this, or phone call, or even grab coffee, whatever works best for you. Anyways, thank you for joining me today. I'm going to be back again next week answering more questions. If you find this helpful and you think maybe a friend, family member may find value from it, please don't hesitate to share my newsletter with them. The newsletter is the only place that you can get access to this recording so far. I haven't made them public yet, so it's kind of an exclusive, you need to know club. But anyways, I appreciate your time. Thank you for joining me on this Friday. Go enjoy the weekend. We will talk again next week.